Joining us on the show is Ajay Srivastava, MD at Dimensions Consulting. Ajay, good morning and welcome to NDTV Profit.
Hey, thank you very much, ma'am.
Ajay, my question coming to you is, how would you look at this bounce back? Do you think it's something which is going to be sustainable from here on, or is it just another bull trap?
I wish I could answer the question, but I guess the answer lies in the fact that certainly there is a reversal in terms of sentiment of selling by FIs, and which gives great comfort to the market because India is naturally accretive on stocks by nature. You know, whether it's your PF which contribute, whether your SIP which are going down but do contribute, new people are coming to the market, capital market penetration is low. So put all the fundamentals together, India is a naturally equity accretive market. Now, what spoils the party, as always, is the FIs coming and selling and selling like nobody's business, and that affected the market. So intrinsically, I think we are a naturally optimistic market by nature, irrespective of fundamental. Sometimes we pay the price severely, sometimes we pay. So my guess is that till the FIs, and this is a caveat, till the FIs purchases come through, I think we don't have a problem in the market. Not too much to do with fundamental because that's not going to change. Nothing changed in the last 3 weeks. What changed is the FI stand saying, I think, oversold this market. It's ripe for a plucking. So I guess is that for the next 6 to 9 months, the key ingredient is going to be that whether there'll be a substantial amount of buying coming from abroad and in what stocks they come into. Because India, investor by nature, buys small mid-caps nature. FIs by nature had huge investment in banking stocks which have not performed for the 5 years. Now, whether we tally on to them and take a performance out of the market, to me, that's the key issue. Number two is euphoria always hurts you. You know, the worst part of the party, the last stage of the party, and you get up with a hangover. So I don't think so. You should pile in big time in this market. You should rejoice, enjoy the recovery in the market, see where the sectors where you were underinvested or you want to change your portfolio. But this is not a gung-ho market that fundamentals have changed dramatically, and therefore I need to go all in. Perhaps we were all or underinvested in the banking segment, which is what is showing, but it will not overperform the market. I can tell you this month, even this rally, the Nifty Next and the mid caps have done certainly better than banking. So they will not overperform your market. So in substance, calm your senses, enjoy the rally, relief to your portfolio, add to what you've missed out, but don't jump in whole hog and says, now the new next bull run has started. It has not started. Wait for March 31st results and we will see what comes through.
Ajay, good morning.
Good morning, Neeraj.
If the March 31st results are a bit disappointing, but maybe on expected lines, and if the commentary from companies around H1 and arguably H2 of FY26 is more constructive, you think the markets will discount a weak Q4?
You know, I have a doubt because see, H1, at least the Q1 is always the weakest Q1 because the summer months, the consumption goes down, and you know the whole thing, the holiday season is partly contributed to the hotels industry.
But the base effect, Ajay, sorry, the base effect of last year for both Q1 and Q2, will that play a part?
You know, the base, no, yes, it will play a part, but base effect was much better. You know, Neeraj, we are ignoring the wealth impact of what has transpired in the economy today. We were all feeling super rich last year. Everybody was feeling super rich. And when you feel super rich, you tend to overspend and you spend the money. And you saw what happened in the real estate market. And you saw in the premium car market, you saw everything going premium, higher prices, hotel, aviation. The wealth impact, it starts to going to hurt you this year because the net wealth of the people who are invested in the markets has now gone down substantially. And that affects your consumption behavior. So my own feeling, and it's showing up already in the quarter that we're seeing going past, that the kind of sales that we used to see in the year-end sales, etc., are not coming through. So fundamentally, the market, I don't think so. The market fundamental will change in performance. Yes, it changed because somebody came and buying big, 7,000 crores of big buying. But performance-wise, I think we will be worse than even the last year's base. It will be very difficult to even make the last year's number if you ask me the most consumer sector of the economy.
So, Ajay, couple of things over here. Now, you're talking about how the earnings probably will look at. Secondly, FI buying is the key trigger that you're watching out for. What would you advise Indian investors to do? Chase the momentum or stay put?
Well, again, there's no Indian investor. It's a question of how much are you invested. Some are even starting off today, for instance. So it's a wrong advice to somebody who's starting off today and saying, don't start your equity portfolio. But if you're over invested in the market, this is not the time to go and leverage yourself and invest more. I think it's a prudent to be at this point of time to be some cash, continues to be cash. You'll get opportunities, but reorder the portfolio. If you were stuck in lots of small caps and lots of companies which are not doing well at all, making losses or whatever it is, this market again gives you a chance to get out of those stocks and move to sectors which are tariff resilient. In my view, that's the first issue in tariff resilient, and normal consumption issue related themes out of it. I think you need to reorient your portfolio, use this opportunity to reorient your portfolio, not to significantly add to your portfolio.
Okay. And when you talk about, reciprocal tariffs as well, to the point that you're making, are you saying that the tariff anxiety is something which will probably cap the upside in terms of domestic markets as well? I mean, yes, there could be pressures in terms of US, but how are you looking at it from the US market perspective? And if that is the case, are you saying an avoid auto, pharma? I mean, these are major sectors.
It's April 2nd is around the corner. So let's not worry too much that if I don't invest today, my fortune will be destroyed by April 2nd. We will know the story on April 2nd, what tariffs come into place. It is certainly a factor from a longer term perspective also, because the world is saying reduce the tariff. Now, when you reduce the tariff, it puts automatic pressure on you on your GST rate domestically. You can't have a very low tariff rate, which is compelling in the international scenario, and have high GST rates domestically. You just seen what happened to this car industry, electric car industry. You saw just tariff reduction has resulted in mayhem in the market. You've seen what's happened to Mahindra is going to get impacted. Tatas are going to get impacted. So, so it's not about tariff is going to just impact that one day it will impact some companies and so on and so forth, but it will also impact the fundamental nature of GST in Indian manufacturing. If you let cars come in the way what's happened for this electric car, it's got a huge impact on the Indian economy by and large, right down to auto ancillaries. So please take tariff as a little bit different scenario, not just the immediate tax for export, but also the fact that it will put pressure on the GST for the government to say, if the tariff on the car is 15% to come into from the country and their local tariffs are 5%, 20% is all, you can't have a GST of 28% and expect the industry to survive. So there are going to be very seminal issues to be discussed on the GST part, which is why I say uncertainty in an environment with high tariffs is going to be highly uncertain for GST. Local companies will pay a price not because of exports, but also because the import will increase the competitive intensity in a market which is not growing as much as we want it to grow. Therefore, prudence is in order. I think last year showed us it was well paid for prudence. Same will pay for today, that euphoria will kill you. But as I keep saying, we are all long in the market, so we have confidence in the market. The question is, which segments are you invested in and whether those segments will perform. I think that's the challenge in the market more than whether one has to be in the market or not.
Yeah, well, substantial moves today in BFSI for sure, and Ajay spoke about that too. A possible linkage to FI buying, and we've kind of seen that right over the last a couple of 2 or 3 sessions. Now, Ajay, if you are getting new money right now, or if you open one of your closets and suddenly pools of capital fell off, I wish they do that. Where would you put that money to work at the current juncture at 23,500 on the Nifty?
We are, okay, let me be honest. We are putting a lot of money in hospital at this point of time. That's one of the key segments we are putting into the money. Domestic hospital chains, we're definitely putting in the money. We are putting in money in select NBFCs at this point of time, and we continue to invest in NBFCs, including just saw one has been taken over at this point of time. And the best part, Neeraj, you got an entry point even lower than what the PE fund was buying at. Now, these are golden opportunities you get. PE funds normally have done a good job of giving returns to their own shareholders. So if a PE fund buys any company, I can certainly believe that you should follow the PE fund, most of them at least, at this point of time, because they give a very good return at this point of time. So, hospital is one segment where we definitely are buying at this point of time large amount of investment. If you ask me, something pops out. And NBFC, large NBFC is in 2 segments that has been buying going on. And I don't think much has been bought in any other segment barring these 2. No. And commodities, if you don't have it, I think it's a must have if you ask me longer term. If you don't have it, buy it. Why? Simple answer. There's no increase in competition. As the rupee depreciates, the local price of commodity goes up, so you're on the safe side. No competition, price kept constantly goes up. All you got to do is to dig and make money. No better industry than commodities.
Ajay, cement, sugar, metals. I'm trying to think what else in terms of commodities, but some people say AI could become commodity too. But yeah, what within the Indian landscape? I mean, is it metals or is it others?
See, as I said, you've got to go for basic commodities, whether it is copper, it's aluminum, and zinc at that point of time. Because this is intrinsically, if you go to the end product, which is converted steel, then you're in a different territory altogether, because then you got tariffs and competing imports, etc. But nobody can import in bulk, alumina in this country. It's counterproductive. You can't just do it. Or, for instance, iron ore. Yes, some was imported, but by and large, we ourselves have, we got to use the local thing. So basic commodities, and luckily, very few companies. So I think you are in a zone where you're safety in money, safety in returns, good dividends. Cement is a dog at the end of the day. It has to be a dog because everybody is competing for a 6% growth rate economy, and everybody wants to add 50 million, 100 million capacity. The words are thrown out as if, what's going to happen? I don't know. Maybe we'll need cement for eating for breakfast at the rate they're growing their companies. And you just saw what happened to cable and wire industries, what happens to competition. So industry may be good, but never forget the competitive intensity. That could kill your returns. You saw that happen in telecom long back. Industry is very good, but now with the competitive intensity gone down, you're making returns. Banking is the same story. It's got 80 banks competing for your business at this point of time. How do you make money out of that, except for the fact that you got a captive saving bank account? So it's the same issue. Look at competition more than just the fact that industry is good. Cement, we are not putting in any money. We have not put any money ever. We have not put money in cement till something really changes.
Okay, Ajay. Great talking to you as always. Thanks for taking the time out and giving us
your
I will
open some cupboards. I will open some cupboards.
You should. You should. If the cash falls out, do share 50% with me. This is a good luck.
I will. Thank you. Thank you very much. Pleasure talking to you.
Likewise. Thank you. Okay. Well, viewers, we wish you all the cupboards and the cash within and the gold within accounted for, of course. So keep that in mind.